Money management. Money is anything that is generally accepted as payment for goods and services. Money is a scarce resource that people must manage to have enough for their needs and wants. Because people's needs, wants, and income can change, it is important to plan ahead, so to have a savings or an emergency fund. Budgeting, saving, and lending. Managing money is one of the most important life skills that you can have, and it causes a lot of problems for people that can't manage money well. A key tool in money management is a budget, a plan for how you will spend your money and anticipating what your expenses will be. Your expenses are money that you spend. A budget is a plan that shows income and expenses over a period of time. A budget's income should be equal to or greater than its expenses. A budget should also include money reserved for saving. Saving is the act of setting aside money for future use. Many people save by using banks. A bank is a business, so they're for profit, that keeps money, makes loans, and offers other financial services. Credit unions are nonprofit. They put all the money back into their customers, so they may pay higher interest rates. Nonprofit banks owned by their members. So it's not a company behind it trying to make a profit. A credit union is a nonprofit. So how a bank works, people deposit money in the bank and they earn a little bit of interest. Interest rates are really low right now for savings. You barely make a penny on $1,000 a year. However, when they loan money to people, if somebody was to buy $1,000 to go towards a car, they would end up paying back about $1,500 because the interest rates on loans are very high. So you end up paying a lot of money back. So the bank paid the interest to the person's money they're borrowing. Really, the bank is borrowing your money if it's in your savings account to loan it out to the other person, to the borrower. The depositor only got a penny and the bank got $499.99. So that's how the bank makes their profit. They make the profit off on the people that borrow the money and pay interest back. And they give very little interest on the savings, but they use your money to loan out. So that's why banks are for profit. They're making money off of using your money. But it's better to have your money in a bank than just sitting at home because you do earn a little interest. It's safer, it can't be robbed, and banks are insured. So if something happened to the bank, there's insurance to cover and make sure that the people get their money back. Many people who save money in banks do so using checking or savings account. Banks may pay interest on money deposited in these accounts. Interest is the price paid for borrowing money. It's also extra money paid. So the bank is borrowing your money, so they're giving you some interest. Interest is an incentive for people to save money because banks need you to put your money in the bank so that they can pay you a little interest, but they have to they want to make a profit and pay their workers. Banks use deposits to make loans to people and businesses around the world. These loans help people buy houses or make other large purchases. They help businesses get started to grow. Often a restaurant would have to borrow money to put the building up and prepare the kitchen and the tables, and then they have to pay the loan back, and they're going to end up paying back a lot of interest, and that's how the bank makes its money. But it's also how the business is able to start, and eventually they'll make a profit above that interest. These loans help people buy houses or make other large purchases. They help businesses get started to grow. As a result, banks are a big part of economic growth. Loans are a form of credit. Credit is an arrangement in which a buyer can borrow to purchase something and pay for it over time, such as by using a credit card. Banks and other lending organizations charge borrowers interest on loans. As a result, it costs more for a borrower to purchase a good using credit, like a credit card, than to pay cash for the good at the time of purchase. So if you use a credit card and you're buying something for $1,000, you're most likely maybe going to pay $1,200 back depending on your interest rate. If you paid cash, you would just pay the $1,000. But often people don't have $1,000 in savings, and with credit, you might pay back $150 a month, and you're going to end up paying more in the long run. But it's what you can afford to pay per month if you don't have the money saved. If you keep a savings account, when you need that $1,000 for a car repair or a home repair, then you don't have to pay the interest if you can pay cash at the time or pay it directly out of your checking account. So paying cash for a good at the time of purchase would cost less. Investing is also important. Investing is the act of using money in the hope of making a future profit. Some people invest in stocks and bonds or mutual funds. A stock is a share of ownership in a company. A bond is a certificate issued by a company or government promising to pay back borrowed money with interest. So it's a guaranteed interest amount that you would get back. There are savings bonds that you can put in $50 and it'll tell you how many years until you double it and you get 100, and then you could cash it in to get the 100 back. So it's a savings plan to earn interest, and they sometimes have higher interest than if they're in the bank. A mutual fund is a company that invests members' monies in stocks, bonds, and other investments. Investments offer different levels of risk and return. So mutual funds are where there's an investment company and they invest in a bunch of different stocks from different companies. So if one company's stock goes down, other companies might go up, and your investment, they call it a portfolio or whatever, the account that you have your money in, might still make money because it spreads it out and it has a lot of people investing, so they can invest bigger amounts and maybe make bigger interest. Investments offer different levels of risk and return. The amount of money an investor might earn. In general, the safest investments offer the lowest rates of return. For example, a savings account is very safe, but it pays a relatively low rate of interest. You're not going to make very much money, but your money's safe. You're not going to lose it in the stock market either. Stocks are riskier, but can earn a great deal of money for an investor if they increase in value. On the other hand, stocks can decline in value and become worth less than the stockholder paid. You could invest $10,000 in a stock market account in a mutual fund, and if our economy really goes down, which it has at times in 2008, a lot of people in those investment accounts, they've had 10,000 in there, it may have only been worth 7,000. So all of a sudden you've lost $3,000. Bonds are less risky than stocks, but they usually offer a lower rate of return. So these are things you'll continue to learn about in your high school economics, and you'll hear talk about as we talk about history and the Great Depression and different times in the U.S. economy as well. So it's important you know some of these basic concepts of economics.